Thank you so much to the four of you for being here for our Funding Pathways panel. And to kick it off, I'm going to have you each just tell us a little bit about yourself and your background. As this panel is all about things startup funding, also let us know what types of startup funding you personally have experience with. And feel free to just jump in here.
I'll
I'll go
start.
first. Oh, go ahead, Shelley.
I think we were at the same time, Sheree. My name is Shelley, and I'm a relationship manager at Mercury. My background is as a founder. I'm from New York, and I started two companies in the ag tech space in New York City. Ran those for about 6 years. They were more lifestyle companies. They were like consulting based companies, but we worked with a lot of startups in that capacity. I then shifted to the accelerator space, and I ran startup accelerators in New York, LA, and Los Angeles, focusing on ed tech. So that was a lot of investor relations and working with founders and kind of building those bridges of relationships between them. And that kind of goes into my work with Mercury as a relationship manager. So I work with some of our high deposit, fast growth startups. And I also work very closely with our venture debt team. So the fundraising that I have the most experience with is venture debt as a resource and an option for startups at specific stages, as well as some other financing options that are not equity that are available to startups.
So I'll go next. Hi, my name is Sheree of the 10K Project. I started out in finance and accounting, and eventually became a business plan writer for clients who are raising capital, mostly from banks and angel investors. And there are a lot of different products I've helped people get funding for, from SBA loans to, again, family and friend round to, angel investors, professional angel investors. But one of the big things that was happening was my Black clients in particular were having trouble getting family and friend money because they didn't have, 5 people who could each put in $50,000 each. So I ended up starting the 10K Project, which is based on crowdfunding. And for us, it's more so equity crowdfunding. So let's say, for example, you have a tech product that you want to get up and running, but you need $75,000 in order to do it. Well, instead of trying to get one person to give you 75,000, and the bank would most likely tell you no, how do you get multiple people, 75 people, to give you $100 each, or something like that? That is what crowdfunding is. It's a bunch of people putting in small amounts of money in order to help you get to whatever the next milestone is in your business and get the funding for it. The government allows you, it's governed by the Securities and Exchange Commission and FINRA, and the government allows you to raise anywhere from $10,000 to $5 million per year with this. So I'll talk more about it as we go.
I can jump in next. So my name is Will Stringer, founder CEO at Chisos and Chisos Capital. Chisos invests directly in people, and I'll get into how we do that later. My background, kind of originally from Texas, went to school there, started my career in banking before moving over to a family office. So I worked at a family office for about 4 years, have some insight into that world, how that works, and really worked on all sorts of deals there. So saw some later stage fundings, saw fundraising for GPs. So if you're raising for a fund, saw that effort there. As I've worked to build Chisos, we specifically ourselves have raised crowdfunding dollars before. So we ran a campaign last summer on WeFunder. So we have some experience crowdfunding ourselves. Some of our portfolio companies have also crowdfunded and are currently crowdfunding. So we do have some experience there. While working in the alternative capital space, since that is where we fit at Chisos, definitely have come across non-dilutive financing, revenue-based financing, all sorts of other alternative financing structures, such as can be found in the book Adventure Finance or Adventure Capital. Ani Patton Power has a book that talks about a lot of alternative financing. So I've got a lot of experience there. And yeah, like I said, I'll kind of go into how Chisos operates later on.
I'll go next. Hi, my name is Armine. I'm a principal at a venture capital firm called SmartGateVC, which is an early stage deep tech investor. And we are typically the first ticket that goes into the company. We are investing anything between $50K to $1 million tickets. We are based across 2 continents. One of our offices is here in Los Angeles. The other one is in Eastern Europe. And I can dig deeper a bit about on the fund and the details later on as the discussion develops.
Awesome. Thank you to the 4 of you for those intros. Real quick, I did want to mention to everyone joining us today, attendees, feel free to use the chat. If you've been to one of our Funding Pathways event before, we probably try to keep this as interactive as possible. And also, as we have a lot of founders joining us today, feel free to introduce yourselves, your business, if you'd like to, in the chat, and write any additional questions you may have as well. I see Amy added here in the chat, and thank you, Shelly, for adding that in as well. I'm just also going to drop the link to the event page, because that's a quick way to, if you scroll down, get quick bios on our speakers, as well as links to their LinkedIn pages and websites. And then I will also be sure to email out after this session with the follow-up info, which will include all of that as well in case you misplace it. All right, awesome. So moving on, for the next question, I'll have each of you, as you mentioned, just dig a little bit deeper into the company you're currently working at and the types of funding that it offers. In just the first few minutes, I've heard crowdfunding, angel investors, VC, non-dilutive or equity-free capital mentioned. So if you could just dig a little bit deeper into those financing models and explain to the founders joining today what that entails, so they can kind of get a sense of whether it would be right for them or not to pursue that funding path. And again, just feel free to jump in here.
I can go ahead and start this time if you'd like. So as I mentioned, we run a venture capital firm. We invest in early stage deep tech founders, and our tickets are between 50K and 1 million. So typically, we will be the first ticket that a founder will receive. So we are very, very early investors. So if someone is building a company that is a heavy IP company, either in AI or in robotics, cybersecurity, IoT, healthcare, or bio, we would be a good investor to look at. And if the company has already raised the seed funding or has raised money, which is between, I would say, up to $1 million or anything between 1 to 3 million, we probably wouldn't be the best investors. We would like to be one of the first ones that go into the company. That answers the first part of the question, I assume. And then as what comes, like what we look at when it comes, but what we look for in the founders and startups that we invest in, I would say we mostly, because we are very early on investors, so we mostly look at the founders, right? What is their backgrounds? What is the problem that they're addressing and how well they know the space? And at the same time, what we have seen is that majority of the time, as the company develops, as it develops from 2 founders coding something in a warehouse or in their houses, it develops into a company. A lot of times, even the value proposition that they offer, even the problem that they solve changes, but the founders stay. So for us, majority of the time, the big portion of like the decision-making process goes into looking at the profile of the founders, their backgrounds, and how well they know the market, how involved they have been in the market where they are trying to address a problem. Did I answer the question, Maya? Anything else I should elaborate on?
No, yes, that was perfect. Thank you. That's awesome.
I can go next. So again, we do crowdfunding at the 10K project, but I'm going to say from a broad point of view, the great thing about crowdfunding is anybody can raise money through crowdfunding. There are 4 primary types of crowdfunding. There's like donation-based crowdfunding. That's the whole GoFundMe piece of it. There is rewards-based crowdfunding. So if you have a product and if people pay, like put money into your crowdfunding campaign, then they could be one of the first ones to get access to the product. There are people who have done movies based on raising money through crowdfunding, through rewards-based crowdfunding, and the reward is when the movie is made, that the people who donated to you will get a ticket. That's their reward. Then there's debt-based crowdfunding. So let's say you already have a business that's up and running, but you need money and maybe you're not bankable for whatever reason. You can do, but you also don't want to give away equity in your business. You can do something called debt crowdfunding, meaning that you would say, you know what, I'll give you an 8% interest rate for the amount of money that you give me. And there are platforms that specialize in all of these. And then the 4th is equity crowdfunding, which is, for the most part, broad overview is I give you money, you give me shares in your company. That's overall. There's a couple of little nuances that are there, like test the waters and things like that, but I'm not trying to get overly complicated with this introductory session. So again, you could be any kind of company. It doesn't matter if you're bankable. It doesn't matter if you are not bankable, if you have bad credit, if you have a company that's not going to make money for the next 3 years. Crowdfunding is very broad with regards to the types of people that can raise money through crowdfunding. Within the 10K project itself, we do focus on Black founders, and we do focus on Black founders that are raising money through equity crowdfunding. And the reason we're different is because we're not a platform or a portal. We're actually a group of investors who actively fund Black-owned businesses. So a lot of times people have issues finding investors. Well, our thing is let's pull the investors together and then let's have a place where Black founders can go in order to pitch their businesses. So that is the way that we work. Maya, if I did not answer something that you wanted answered, you can let me know as well.
No, that was also perfect. Thank you very much for getting into that. Super helpful.
I'll follow up after Shuri. And by the way, Shuri, I'd love to connect with you offline and talk about your organization. Huge fan of what you're building. I think I wanted to kind of follow up from what you were saying, because venture debt is very different from crowdfunding or some of the other options. And that doesn't mean that it's not important for founders to know that it exists. So I'm saying this with the understanding that it is likely that, especially if you're just starting out, you might be too early for venture debt. But something I found when I was running accelerators is many founders didn't even know that this was a product that existed. And it is something important to know as you plan your longer term fundraising strategy. So venture debt is a very specific type of lending product that is designed to work in partnership with your last equity fundraise. So this is a fundraise that you would do with institutional VCs, your seed or your Series A, Series B, that's what we mean by that. And venture debt can loan you between 25 to 50% of your total raise amount in the form of debt. And this is a good thing for founders because the interest and kind of the cost of capital that you get from debt is a lot cheaper than the cost of capital when you raise equity. So just like Shuri was talking about, when you have equity, you're giving up shares of your company, you're giving up ownership, you're diluting your ownership. And venture debt is a great way to get an additional kind of boost of funding that is much less dilutive, enables you to keep more ownership kind of upfront, minimize your dilution. And really the reason why we have venture debt is you already raised a bunch of money. You have a bunch of cash. This isn't that situation that you do, right? You want to be able to make that last as long as possible, make your runway as long as possible before you have to raise again. Because the longer your runway is, the more time you have to achieve milestones, achieve more growth, increase your valuation. So the next time you do raise, you'll be in a better position. And that's really where venture debt comes in. So we see venture debt be very valid for companies that are raising, in the like over $2-3 million raises from institutional VCs. That's kind of roughly, and again, every lender is different. So I'm only speaking from Mercury side, but there's a lot of different options out there and not all are created equal. So that's another thing is, educate yourself on the different options and, try to find the terms that make the most sense for you as a founder. Mercury works very hard to be very founder focused in our product. I'll stop there and we'll see where it goes.
This is a great group. We've got equity only, we've got venture debt, and we've got crowdfunding. And now Chisos is kind of a unique animal all in itself. So like I said, we invest in people. Like to say we invest specifically for entrepreneurs, napkin stage all the way to a seed bridge. And so what that means is we can come in day one, either alongside friends and family, or sometimes even before friends and family, if maybe you don't even have a company idea yet, which we have done before. And the way we do this is by using our terms called a convertible income share agreement. And it's essentially a combination of two instruments. One is an income share agreement that's similar to what is used in the education space. We basically take that and use that agreement with the individual founder in this case. The second instrument is a slightly modified YC safe, where we target a specific percentage versus a face dollar value. And we combine both of those to write checks up to $50,000. So we'll come in somewhere between $15,000 and $50,000. We underwrite both the founder on an individual basis, as well as the company. So we have an open online application. When a founder comes in and applies, they fill out some information really in three main buckets. One is the founder's kind of personal financial information. We're looking at income, career, education, debt to income ratios, those types of things. Two, there's some psychographic information we're looking for: grit, hustle, ambition, leadership, coachability, those types of entrepreneurial traits. And then lastly, we do look at the business to understand, what type of business is it? What is the scalability? What is the capital efficiency? Is it viable? We're not investing in single location brick and mortar. We are looking for a little bit of scalability, but it doesn't have to be a unicorn. If it's a bootstrapped software company that can get to $1 million in ARR, that's great. You can have a couple $1 million exit, and that's awesome. That works for us. Like I said, we're really underwriting and investing in the individual. And today, in this case, those individuals are entrepreneurs.
Awesome. Love that so much. Thank you to the four of you. And also to reiterate what Will just said, I think it's great how we really do have kind of a diversity represented here of different funding options. That's our goal with these events, the Funding Pathways events, to really represent, that there isn't just one way for founders to attain funding and go on their fundraising journey. And it also shouldn't be that way, because there are just so many different types of businesses, so many different types of needs. And so finding that fundraising path that is there to suit and complement your needs and who you are as a founder and what industry you're in and all of that is the end goal. So I think it might actually be useful for us to transition to our breakout rooms soon, just because everyone here is, has something a little bit different to offer. And so once we get everyone, all the founders in the room, able to kind of choose who it is that they would like to connect and ask a little bit more questions with, that could be more beneficial. But before we transition to that, I will just ask one last kind of more general question. Again, hard to tailor this to everyone, but if you could just provide a little more context on, for your specific type of funding, and I think Will, you just did a really good job of just kind of like what it is that you're looking for in a founder or a company, just so that those in the room, when they're starting to think of like, all right, I'm starting to fundraise soon, I'm thinking about fundraising, how they can put themselves in a position to be ready for that, and kind of be timely on that.
Well, I will go first. So specifically with what we do with equity crowdfunding, it is governed by the Securities and Exchange Commission and FINRA, which means you have to fill out paperwork with the United States government. And you actually have to be accepted by a FINRA approved equity crowdfunding portal. But even before then, you need to, number one, I think have like your business plan together. You need to know all of your market research. You need to figure out where the business is going, who your team is, and things like that. So if you go to the website roadtocrowdfunding.com, we actually have a what do you call it, intro session for people that will give you like in detail a lot of the things that you need to know in order to even decide if this is what's best for you, and to give you like the checklist of things that you need in order to get this up and running. So that's going to be a resource that I leave with people, and I'll also put in the chat for everybody.
I can go next. So on our end, to answer the question, what we are looking for in founders when what we are looking for in a company when they're investing. So a few main things, probably we want the founders to be working on a problem that is problem and solution that is scalable, which basically means that we can get big returns on the investment that we make, because we are very early on, so we would expect 30 times return on investment that we make as a VC fund. So scalability is super important to us. If you are working on a problem that is addressing a market that is, let's say the total market is like 100 million and you're trying to compete with 300 other companies to grab a portion of the market, then we probably wouldn't be interested to look into the company, because it's a very small market for 300 companies to share. So we want big market and a problem and a company that can scale. Next thing would be strong founders. And what I mean by strong founders, as I said, they're betting on the founders from the day one. We're betting on the ability of the founders to scale and build the business. So relevant backgrounds, experience in the field, and coachability, I would say. Probably that's the best way to put it. How fast the founders learn, how fast they iterate, how fast they can grow. And the last thing I would say, probably as we're a deep tech fund, would be a heavy IP into the company, which basically means some kind of technology advantage, which can't be very easily replicated. And as long as we have, I would say, as long as we have the strong founders portion of the things, the rest we can work around with the founders to figure out if there's anything interesting. And the IP portion is kind of important. If the founders are working on a B2C company, which is very generic, which can be easily replicated, then we probably would prefer not to be the first investors in this kind of company, because it's not typically our focus area. As long as we have these two things, we'll work around the rest and we'll help the founders to grow the business from very, very early prototype or an MVP to a viable something that can scale and that can raise bigger amounts of money beyond seed round.
I can jump in here. Yeah, like I said, we're looking for, on the business side of things, capital efficient and scalable, but it is industry agnostic. So many times these businesses that we're looking at are pretty early. And so there's not a ton of traction there, if any traction, which again is fine. We do just want to see some kind of viable, feasible business. Does the founder understand the market that they're going into? Do they understand their customers? Do they have a relevant business model? How are they going to make money? Does it make sense? But really, we're looking for traits in the founder and financial traits as well as psychographic traits. So our, let's call it average, previous income level sits somewhere around $80,000 to $90,000 for us to make an average of about $40,000 investment. Now, obviously, there's a ton of factors that go into that. So, if you're really early in your career and haven't had a chance to really move up in your career, then that totally changes the math. So, that income threshold could be much lower. If you have run your career and you're kind of steady state in your career, then that's where that kind of $80,000 to $90,000 is what is an average income level of some of the founders that we've invested into. No single factor is disqualifying. So we've made investments where the founders specifically have had really, really terrible credit scores, but there have been specific reasons that make sense, and they've had a good business, and they've shown that they can be successful, whether that's starting another company, starting a nonprofit, moving up through their career, overcoming adversity, just something that shows you're willing to work hard and you can get stuff done. You can get stuff accomplished. Those are some of the kind of softer, more subjective things we're looking for on top of looking at the business, which again, industry agnostic. One thing we'll add is we can only invest in US citizens and permanent residents today. We're hoping to figure out how to expand that at some point in the future.
Thanks, William. So the kind of broad requirements for venture debt, I'm going to kind of connect this with also banking. We provide banking services. So whether or not you are an existing Mercury customer, if you ever do get venture debt from us, one of the requirements is you move your banking to Mercury. I kind of want to focus more on the importance of choosing a bank partner as a startup founder and working with a bank that will be as least annoying as possible. Usually that's a very frustrating part of the founder journey is the financial kind of banking process, especially when you're still doing most of it yourself. But yeah, broadly, we do also kind of echoing William, we can only at this time provide debt to companies that have a US entity and that have the majority of their operations in the US. So that's kind of one of the bigger requirements for us. We are also looking at companies at this stage that have raised a minimum of $5 million from institutional VCs. And this number, by the way, changes as market conditions change. So it's definitely something, worth checking in. These things are never set in stone. But that's kind of roughly where we're at. And the last piece, which is probably relevant to, the other panel members here, is for venture debt, we look for a cap table that has majority institutional VCs on it. And so that is not to say that family offices or angels are not valuable investors in the company. It's just part of our underwriting process and kind of how we structure that underwriting. So those are sort of the three major checks. And important to note that venture debt is a very, very specific, niche product, and it's not, it kind of fits a very specific purpose. So it's not like a plus or minus to your company's, health or business if you don't qualify for venture debt. It's the kind of thing that if it fits, it's great. And if not, then, maybe in the future.